Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about WORKIVA Inc. Annual Report. WORKIVA Inc. offers a range of businesses and services through its cloud-based reporting solutions. The company's primary product is the WORKIVA platform, which provides data linking capabilities, audit trail services, and access management for administrators. This platform connects and transforms data from various enterprise systems, including ERP, HCM, and CRM systems, as well as other third-party applications. The company serves a diverse range of clients, including public and private companies, government agencies, and higher education institutions. By providing these cloud-based reporting solutions, WORKIVA Inc. enables its clients to streamline their data management processes and improve the accuracy and efficiency of their financial reporting. Unfortunately, I don't have access to the text you provided. However, I can still provide a general overview essay on what might cause a stock price to drop. The decline of a company's stock price is often a complex issue with multiple contributing factors. One possible reason for a decrease in stock value is poor financial performance, such as declining revenue or increasing losses. This can be due to various internal issues, including inefficient management, lack of innovation, or failure to adapt to changing market conditions. Another factor that may contribute to a drop in stock price is external events beyond the company's control. Economic downturns, industry-wide disruptions, or regulatory changes can all negatively impact a company's financial performance and subsequently its stock value. Additionally, negative news coverage, scandals, or controversies surrounding the company can also erode investor confidence and lead to a decline in stock price. In some cases, a company's stock price may drop due to overvaluation at the time of purchase. If investors have bid up the stock price too high, it may be difficult for the company to meet expectations, leading to a correction in the stock price. Finally, changes in market sentiment or investor preferences can also cause a stock price to decline. In summary, a decline in stock price is often the result of a combination of internal and external factors that negatively impact a company's financial performance and investor confidence. WORKIVA Inc. maintains a market capitalization of $3 billion, broadly in line with the industry peer group. WORKIVA Inc. trades at a lower price-to-book ratio of -633.3 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 103% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline for a company are multifaceted. On the growth side, subscription and support revenue is a significant contributor, increasing by 21.7% in 2025 due to strong demand and continued solution expansion. Professional services revenue, on the other hand, remains relatively flat compared to the previous year. Foreign currency exchange rates and inflationary factors also have a potential impact on revenue growth or decline. The company's ability to increase prices for subscription-based solutions can mitigate the effects of foreign currency exchange rate fluctuations. Inflationary factors, however, may lead to increased operating expenses as a percentage of revenue. On the decline side, advertising costs and research and development expenses are notable contributors. Increased advertising costs by $8.1 million in 2025 compared to 2024 may negatively impact revenue growth. Research and development expenses, although not directly related to revenue growth or decline, can still have an indirect impact on the company's bottom line. Other key points include accounts receivable, net of allowance for doubtful accounts, which increased by $20,551,000, 14% growth, from 2024 to 2025. Deferred revenue also saw a significant increase, rising by $90,311, $457,608 in 2024 to $547,919 in 2025. The introduction of convertible senior notes, current, with a value of $71,072 in 2025, is another notable point. In conclusion, the primary drivers of revenue growth or decline for this company are influenced by various factors, including subscription and support revenue, professional services revenue, foreign currency exchange rates, inflationary factors, accounts receivable, net of allowance for doubtful accounts, deferred revenue, and convertible senior notes. The net income of the company has been a subject of concern for several years. Historically, it has been negative, with net losses recorded in 2025, 2024, and 2023. The situation worsened in 2025, when the net loss increased by $5.2 million compared to 2024. This decline was attributed to lower interest rates and losses on foreign currency transactions. The profit margins of the company have also been a challenge. Due to uncertainty surrounding income tax rates and potential changes in tax laws, the company's profitability has been impacted. Furthermore, an increase in sales and marketing expenses, as well as general and administrative expenses, has put additional pressure on the company's bottom line. These factors combined have made it difficult for the company to achieve profitability. The company's financial performance indicates a consistent trend of generating positive operating cash flow. According to the provided data, the company has been able to produce a surplus in its operating activities for 3 consecutive years. In 2025, the company generated an impressive $140,070 in operating cash flow, demonstrating a significant increase from previous years. This is a testament to the company's ability to manage its operations efficiently and effectively. The data also shows that the company has maintained a positive operating cash flow in both 2024 and 2023, with amounts of $87,706 and $70,875 respectively. These figures indicate a steady growth in the company's operating performance over time. Overall, the evidence suggests that the company is successfully generating positive operating cash flow, which is a crucial indicator of its financial health and stability. The company's debt level and interest expenses have undergone some changes over the past few years. In terms of debt level, there has been a significant increase from $662,361,000 to $769,918,000 between December 31, 2024 and December 31, 2025. This represents an increase of approximately $107 million. However, upon closer inspection, it appears that the increase is largely due to the growth in the 2028 notes, which increased from $694,090,000 to $696,263,000. The 2026 notes actually decreased slightly. Additionally, there was a small increase in U.S. Treasury debt of $13,064,000. In terms of interest expenses, there has been a slight decrease from -$12,865,000 in 2024 to -$12,777,000 in 2025. This represents a reduction of approximately $88,000 or 0.7%. The total interest expense remained relatively flat at $12,019,000 in 2025 compared to $12,012,000 in 2024. Overall, while there have been some changes in the company's debt level and interest expenses, they are not significant enough to indicate a major shift in the company's financial situation. Management is projecting a positive outlook for the company, expecting continued expansion over the next several years. They believe regulatory requirements will drive demand for their solutions and plan to accelerate investments in sustainability management to meet growing stakeholder needs. The company sees opportunities for growth through global expansion, strategic investments in research and development, and selling multi-solution deals. Management is focused on 4 key areas: connected AI-powered platforms, fit-for-purpose solutions, global expansion, and partner ecosystems. They expect to remain competitive by bringing new capabilities and versions of existing solutions to market quickly. The company also sees opportunities in the expanding business reporting market and plans to drive growth through strategic investments. While management acknowledges various risks and uncertainties, including intensifying competition and potential loss of customers, they are optimistic about the company's future prospects. They believe their strong focus on cybersecurity and established risk management mechanisms will help mitigate these threats. Overall, management is confident in the company's ability to navigate challenges and achieve continued growth and expansion. The company's financial policies have been outlined in its recent reports. One notable aspect is the decision not to pay dividends to shareholders. This means that instead of distributing a portion of the company's profits as dividends, the funds will remain within the organization. On the other hand, the company has authorized share buybacks up to $350 million. This indicates that the company is willing to repurchase its own shares from the market, which can help boost shareholder value and potentially reduce the number of outstanding shares. That concludes the financial summary for WORKIVA Inc. Feel free to comment below, and I will be happy to answer them when possible.